percentage of the economy, of the American population, and everybody in it, and in a leveraged way.
We've gone from elevated to worrisome.
SoftBank did what some might have said was unthinkable before. It sold its entire stake in NVIDIA.
Something very strange is unfolding in the US stock market. Every single day, traders are now buying and selling options worth more than $3.5 trillion. Let that number sink in. $3.5 trillion per day. That's roughly equal to the entire market value of the Russell 2000 index, which represents all US small-cap companies combined. In other words, the amount of leverage that's being placed daily is now comparable to the value of thousands of real businesses across America. This didn't happen overnight. It's the result of a trend that has been quietly accelerating for nearly 5 years, starting around 2020. And interestingly, that exact moment also marked the beginning of one of the most aggressive rallies in modern stock market history. After the pandemic crash, the S&P 500 didn't just recover, it exploded higher. First, the index doubled from its pandemic lows. Then, starting in 2022, it nearly doubled again. Returns like these don't just increase portfolio values, they change behavior. When markets rise for years without major setbacks, confidence slowly turns into certainty, and certainty almost always leads to more risk-taking. We can see that clearly when we look at margin debt. Margin debt is the amount of money investors borrow to amplify their stock market bets. On the New York Stock Exchange, margin debt has now surged to roughly $1.2 trillion. That's not just high, it's historically extreme. Over the last year alone, margin debt has grown by around 45%. Growth at this pace has only happened a handful of times before, most notably in 2021, and before that in 2008, both periods that ended very badly for investors who arrived late to the party. Naturally, this has caught the attention of some of the most well-known investors in the world. Ray Dalio has been more cautious, Michael Burry has raised concerns, Howard Marks has warned about excess risk, and Warren Buffett continues to sit on record levels of cash. When names like these start waving yellow flags, people listen. But here's the problem. If you look back over the last decade, famous investors have been cautious many times. And if you had sold stocks every time a respected investor sounded the alarm, you would have been waiting for a major crash for years, while the market kept climbing higher. That's what makes the current moment so tricky, because now we're dealing with a genuine frenzy in options trading, rapidly expanding margin debt, and record-breaking valuations. So the question becomes unavoidable. Are these warnings finally justified this time, or is this just another moment where fear arrives too early? To answer that, we need to step back and look at the data. Let's start with long-term returns. If we look at the 10-year return of the S&P 500 going back more than a century, a clear pattern emerges. Most of the time, 10-year returns fall into a fairly normal range, but every once in a while, they explode higher. Today, the S&P 500 has gained roughly 235% over the last 10 years. That is extremely rare. Historically, this has only happened during a few distinct periods: the late 1990s, the early 1960s, and briefly the 1920s. But what makes the current situation even more unusual isn't just the strength of returns, it's what's happening beneath the surface of the economy. If strong market returns were the only unusual thing happening right now, this story would be much simpler. But there's another data point that makes the current situation truly strange: consumer sentiment. If we overlay a long-term survey of US consumer confidence, such as the University of Michigan's Sentiment Index, on top of stock market performance, a clear historical relationship appears. Whenever the stock market delivered exceptionally strong returns over long periods, consumers generally felt optimistic about the future. People felt confident about jobs, confident about income, confident about economic growth. That optimism made sense. But today, that relationship is broken. Despite the S&P 500 pushing to record highs, consumer sentiment in the United States remains near some of the weakest levels seen in decades. In fact, Americans today report feeling almost as pessimistic as they did during the global financial crisis, and even comparable to how people felt in the late 1970s and early 1980s when inflation was running into the double digits. The reason is simple. The US has been going through a prolonged cost of living squeeze. Housing costs remain high, food prices jumped, interest rates surged, and for the average household, financial stress has become a daily reality. Yet at the same time, the stock market continues to climb higher, almost completely ignoring these pressures. For the first time in modern history, financial markets appear detached from how the majority of consumers actually feel about the economy. From this angle, it's easy to conclude that the stock market is living in a fantasy, that it's standing at the edge of a cliff, just waiting for reality to catch up. And not temptation leads many investors to the same dangerous thought. If this is a bubble, why not short it aggressively? But before anyone sells their house to place a leveraged bet against the stock market, there's an uncomfortable truth we need to address: market timing. Because as irrational as markets may seem, they often stay irrational far longer than most people expect. And there is a reason why stocks are rising, even while consumers are struggling. To understand it, we need to shift focus away from emotions and toward expectations, specifically earnings expectations. This chart shows what Wall Street analysts believe S&P 500 companies will earn over the next 5 years. In simple terms, it represents how fast analysts expect corporate profits to grow. Today, those expectations are extremely optimistic. Analysts are projecting roughly 18% annual earnings growth over the next 5 years. That's nearly double the long-term historical average of around 10%. At first glance, that sounds unrealistic, but these projections aren't pulled out of thin air. They're being driven by real results. A small group of massive companies has been posting extraordinary earnings growth. Companies that dominate cloud computing, digital advertising, artificial intelligence software, and advanced semiconductors. Firms like these generate revenue streams that are only loosely connected to the financial health of the average American household. Advertising budgets may fluctuate, but digital platforms continue to capture market share. Cloud infrastructure continues to expand. AI adoption is accelerating across industries, and advanced chips remain strong. Investors understand this distinction very clearly. That's why these companies now carry the largest weightings inside the S&P 500. And as long as these firms continue delivering strong earnings growth, the index as a whole can keep rising, even if the broader economy feels weak. This helps explain why consumer sentiment and stock prices can diverge for extended periods. But history gives us an important warning. High growth expectations are a double-edged sword. When expectations rise, valuations rise with them. And when valuations become stretched, markets grow increasingly fragile. If growth continues, prices can keep moving higher. But if growth disappoints, even slightly, the downside can be violent. We can see this clearly when we look at valuation metrics like price-to-earnings ratios. Today, market valuations sit near levels last seen during the dot-com bubble, not because earnings are weak, but because expectations are extremely high. This means the margin for error is thin. The real question now becomes this: what could cause those growth expectations to break? To answer that, we need to look at history one more time, and specifically, we need to look at what actually ends bull markets. When we zoom out and study the major market crashes of the last 50 years, a surprising pattern appears. Despite very different triggers, different narratives, and different economic backdrops, most major bear markets share one critical ingredient: inflation. If we overlay the US inflation rate on top of long-term stock market data, the pattern becomes hard to ignore. Nearly every major market crash occurred when inflation was trending above roughly 3.5%. The late 1980s, the dot-com bubble, the global financial crisis, the 2022 bear market. In each case, inflation either surged past that threshold or re-accelerated after a period of calm. And when that happened, markets didn't just slow down, they snapped. The reason is straightforward. Inflation directly impacts interest rates. When inflation rises, central banks are forced to tighten policy. Even without central bank action, bond investors demand higher yields to compensate for the loss of purchasing power. Higher rates increase borrowing costs. Higher borrowing costs reduce liquidity. And when liquidity dries up, risk assets like stocks come under pressure. This is why inflation has historically been the most reliable bull market killer. There is one major exception: the crash of 2020. That collapse happened while inflation was still low, but that event wasn't driven by economic overheating. It was caused by a sudden external shock, a global pandemic that shut down the world almost overnight. Outside of that unique episode, inflation has consistently been the force that ends periods of excessive optimism. This brings us back to the present moment. Despite all the speculation, leverage, and extreme positioning in today's market, inflation has been trending downward. That's a crucial detail. For the past 2 years, the core driver behind the current rally has been easing inflation combined with expectations of future rate cuts. As long as inflation continues to cool, financial conditions remain loose enough to support elevated valuations. This is why calling a top has been so difficult and why many bearish arguments have failed prematurely. Even Ray Dalio, one of the loudest voices warning about bubbles, has acknowledged this reality. He has argued that markets can remain in bubble territory for years as long as the conditions that support them stay intact. The late 1990s are a perfect example. Valuations were extreme, speculation was rampant, warnings were everywhere, and yet the S&P 500 continued climbing for nearly 5 more years, eventually tripling before the bubble finally burst. The lesson is uncomfortable, but important. Being right too early can be just as costly as being wrong. So what actually matters now? Not consumer sentiment, not scary headlines, not even famous investors sounding alarms. The key variable to watch is inflation. The moment inflation meaningfully turns back up, the risk profile of the entire market changes. Liquidity tightens, earnings expectations come under pressure, and valuation multiples stop expanding. That's when bubbles get pricked. Until then, the market can continue behaving in ways that feel disconnected from everyday economic reality. This doesn't mean risks don't exist. They absolutely do. High leverage increases fragility, extreme expectations increase vulnerability, and narrow market leadership concentrates downside risk. But risk alone doesn't end bull markets, catalysts do. At the moment, that catalyst hasn't arrived. This is why our approach has remained balanced. Rather than betting aggressively against the market, we stay positioned where fundamentals remain strong. Select large technology companies with durable earnings growth, defensive sectors like healthcare that continue to outperform, and real assets such as industrial metals, where supply constraints and long-term demand trends create asymmetric opportunities. At the same time, we stay alert. We watch inflation closely, we monitor liquidity conditions, and we remain ready to adjust when the data changes. Because when inflation eventually re-accelerates, the environment will shift quickly. And when it does, markets won't politely give investors time to react. They never do. For now, the frenzy may look unsustainable, but history suggests that bubbles don't burst simply because people notice them. They burst when the forces holding them up finally weaken. And in today's market, inflation remains the force that matters most.